Hey everyone, welcome back and thank you so much for watching. So I know personal finance and investing can seem really intimidating, especially if you're just starting out, or maybe you've tried investing before and you lost money. But here's the truth. The stock market is one of the best ways to build real wealth over time. And by the end of this video, you're going to understand how to invest with confidence. You're going to learn the fundamental strategies that separate people who build real wealth from those who make impulsive decisions, and you're going to walk away with the tools you need to start, even if you only have 50 bucks. So what I want you to do is grab a notebook, if you can, and take some notes, because this is going to be a comprehensive guide on smart investing for 2025 and beyond. And I really encourage you to watch this at your own pace. So if you need to pause and take notes, go ahead and do that. Or if you want to watch it all in one sitting, that's totally cool. Just know that we're covering why you should invest right now, how to think about risk and return, the fundamentals of how the stock market works, the different types of accounts you can use, how to evaluate and research investments, and practical strategies to build a portfolio. So I really hope you're ready to dive in. Let's talk about something that I think is probably the biggest barrier to entry for most people, and that's understanding the basic concept of what the stock market even is and why it exists. Okay, so when you buy a stock, you're buying ownership in a company. It's that simple. When you buy a share of Apple, you now own a tiny fraction of Apple. You own a claim on its assets, its earnings, and its future growth potential. The stock market is just the mechanism that allows millions of people to buy and sell those ownership stakes on a daily basis. It's a marketplace that's completely digital now, and it's been around for centuries. But the important thing to understand is that companies sell their shares to the public primarily to raise money for growth and to fund their operations. They need capital, and by selling shares, they can access billions of dollars to expand and innovate. When you invest in those shares, you're betting that the company will grow in value over time. And when the company grows, the stock price typically rises, and your investment grows along with it. Now, here's where it gets really interesting, and this is something that most people don't fully appreciate, and that's the concept of compound interest. Albert Einstein called it the eighth wonder of the world, and I think that's actually pretty accurate. So let's say you invest $1,000 and you get an 8% return in year one. You now have $1,100. In year two, you get 8% on the bigger number, so now you have $1,280. And if you keep doing this for 30 years, you end up with over $10,000 from that initial $1,000 investment. And the longer you stay invested, the more powerful this effect becomes, because you're earning returns on your returns. And this is why starting early is so critical. Even if you can only invest small amounts, the time component is what really makes the difference. So let's talk about why you should care about investing right now. The first reason is inflation. If your money isn't growing faster than inflation, you're losing purchasing power every year. The Federal Reserve targets 2%, but we've seen much higher recently. So cash in a savings account earning barely anything means you're actually getting poorer in real terms. The second reason is that stocks have historically provided the best returns of any asset class over the long term. Real estate, bonds, commodities, none have matched stocks over the past 100 years. The stock market averages 8 to 10% per year, which outpaces inflation and builds real wealth. The third reason is you want your money to work for you instead of working forever. The whole point of investing is building passive income that grows without effort once you set it up. If you invest early enough, you could retire comfortably or have more flexibility in life. So those are the main reasons to get started. And now let's actually talk about how much money you can realistically make through investing, because I think this is where a lot of people get confused. They think the stock market is some kind of get-rich-quick scheme, and then they get disappointed when they don't turn 500 bucks into 50,000 in a year. The reality is that the stock market is a long-term wealth-building tool, not a lottery ticket. But let's work through a realistic example. So let's say you make $70,000 a year after taxes. That gives you roughly $45,000 to $50,000 to work with. Your living expenses are $35,000, leaving you about $1,000 per month to invest. Not huge, but workable. Let's say you start with $5,000 saved and commit to investing $1,200 monthly at an 8% average return over 30 years. You'd have around $1.2 to $1.5 million. Your total contributions would be about $430,000. So the difference between what you put in and what you have is growth and compound interest. That's the magic of long-term investing. The key thing to understand here is that this isn't guaranteed, and markets do go down some years. The S&P 500 was down 18% in 2022, but then it was up 25% in 2024. The point is that if you hold for long periods of time, like 20 to 30 years, the ups and downs average out, and you generally come out ahead. So now let's get into some of the actual terminology and concepts you need to understand if you're going to be talking about stocks and investing. Bull versus bear markets is something you're definitely going to hear a lot. So a bull market is when prices are going up and sentiment is positive, and people are bullish on the future. Bearish means the opposite. You expect prices to fall and you have negative sentiment about a market or a stock. The easiest way to remember it is bulls have horns that point up, and bears have claws that point down when they attack. Pretty simple, right? Another term is market cap or market capitalization, and this is really important because it tells you the size of the company you're looking at. If a company has a market cap under $300 million, it's considered a micro cap, and these are highly speculative and risky. Small caps are between $300 million and $2 billion. Mid caps are $2 to $10 billion, and large caps are over 10 billion. Mega caps like Apple or Nvidia are hundreds of billions or trillions of dollars. So the smaller the company, the more volatile the stock tends to be, but also the more potential for growth. If you're just starting out, you probably want to stick with larger, more established companies because they're more stable. Another key concept is an index. So the S&P 500 is an index that tracks the largest 500 companies in the United States. The Dow Jones tracks 30 blue chip companies, and the Nasdaq tracks mostly technology companies. These indexes serve as barometers for overall market health. When people say the market is up today, they usually mean the S&P 500 is up. That's the benchmark everyone uses. A blue chip stock is just a term for a really high-quality established company. Think Apple, Microsoft, Coca-Cola, Johnson & Johnson. These are companies that have been around forever and are considered very safe and stable. Then you have penny stocks, which are the exact opposite. These are tiny companies that trade for very low prices, and they're incredibly risky. Lots of speculation, and lots of people lose money on them. So as a beginner, you definitely want to avoid those. Then there's the concept of dividends, which is really important to understand. A dividend is when a company decides to share its profits with shareholders. So if you own shares of a company and they pay a dividend, you'll get paid just for owning the stock. It could be quarterly or annual payments. Some investors love dividend stocks because it creates passive income on top of the potential price appreciation of the stock. So if you own a dividend stock that goes up in price and also pays you dividends, you're making money two different ways. Now let's talk about how to evaluate and research stocks, because not all stocks are created equal, and you need to have a framework for understanding whether a stock is a good investment or not. When you're looking at stocks, you can use what's called fundamental analysis, which means you're looking at the underlying health of the company. So things like revenue, profit margins, cash flow, assets, and liabilities. You compare the company's fundamentals to other companies in the same industry, and you try to figure out if the stock is overvalued or undervalued. The most important metric people use is the price to earnings ratio, or PE ratio. This is calculated by taking the stock price and dividing it by the company's earnings per share. It tells you how much investors are willing to pay for every dollar of earnings the company makes. A PE ratio of 20 means investors are paying $20 for every $1 of profit. If the PE is high, it could mean investors think the company will grow really fast in the future, but it could also mean the stock is overvalued. If the PE is low, it might mean the company is undervalued, but it could also mean there's a reason no one wants to buy it. Context matters a lot when you're looking at these numbers. You also want to look at the price to sales ratio, which works similarly but uses revenue instead of profit. This is useful for companies that aren't profitable yet. Then there's free cash flow, which tells you how much cash the company generates each year after paying for everything it needs. Free cash flow is really important because it shows you whether the company is actually healthy and sustainable. If free cash flow is increasing, that's usually a good sign. If it's decreasing, you need to figure out why. Now, another approach is technical analysis, which is what a lot of traders use. They're not looking at the company fundamentals at all. They're just looking at price patterns and charts, trying to figure out which direction the stock is going to move. They're trading based on momentum and trends. This is a much shorter term approach, and honestly, for beginners, I think it's riskier because you're basically trying to time the market, which is really hard to do consistently. So let me introduce you to the fundamental investing approach, which I think is much better for beginners. The idea is you buy high-quality companies that are undervalued, and you hold them for years or decades, and you just let the compound interest do its thing. You're not trying to time the market. You're not trying to get rich quick. You're just trying to get good returns over a really long period of time. And statistically, this approach outperforms most active traders and beats most professional fund managers over time. So if you're going to start investing, I think this is the mindset you want to adopt. And now let's talk about what account you should use to invest. Because you can't just buy stocks in your regular bank account. You need a specific type of account. The most common is a regular brokerage account. That's what most people use. You can open one with companies like Fidelity, Charles Schwab, Vanguard, Robinhood, or many others. Once you open the account, you link your bank and transfer money in, and then you can buy and sell stocks and funds inside that account. There are also retirement accounts which have special tax benefits. The most popular is the Roth IRA, which is absolutely incredible. If there's one thing you remember from this video, it's to open a Roth IRA. The way it works is you put in money that you've already paid taxes on, but then all the growth inside the account is completely tax-free forever. So if you put in $7,000 and 30 years later, it grows to $100,000. You don't owe any taxes on those $73,000 in gains. That's massive compared to a regular brokerage account where you'd owe taxes on those gains. The catch is there's an annual contribution limit of $7,000, and you have to earn income to contribute to it. There's also a traditional IRA, which is similar, but the money going in is tax deductible, and then you pay taxes when you withdraw it in retirement. Then there's the 401k, which is an employer-sponsored plan. Most companies offer them, and they're great because many employers match some of your contributions, which is basically free money. So my recommendation is open a Roth IRA. If you can, max it out every year. And if you have a 401k at work, take full advantage of that, especially if your employer matches any of your contributions. After that, if you have extra money to invest, you can open a regular brokerage account and invest more there. Now let's talk about the actual strategy you should use as a beginner to build your portfolio. And I'm going to recommend something called the 3-fund portfolio. This is the simplest, most effective approach I know, and it's what a lot of smart investors use. The idea is you take your money and you split it between 3 index funds, one that tracks the broad US stock market, one that tracks international stocks, and one that tracks bonds. That's it. The US stock fund gives you exposure to the economy of the United States. The international fund gives you exposure to companies around the world. And the bond fund gives you some stability and diversification. The allocation you use depends on your risk tolerance, but a common approach is 60% US stocks, 30% international stocks, and 10% bonds. As you get older and closer to retirement, you might shift more toward bonds, but when you're young, you can be more aggressive. So let me give you a concrete example. Let's say you have $5,000 to invest. You decide to go with 60, 30, 10. So you'd put $3,000 in a US stock index fund like VOO or VTI. You'd put $1,500 in an international fund like VEA, and you'd put $500 in a bond fund like BND. Then every month you invest another $500 and you split it the same way, 60, 30, 10. So you're always maintaining that balance, and you're not thinking about it. You're not checking the stock prices every day. You're just investing consistently and letting time and compound interest work for you. That's the power of this approach. It's simple, it's cheap, it works, and it's boring, which is actually the best thing about it, because boring means you're not tempted to do stupid things. You're not trying to time the market. You're not chasing hot stocks. You're just building wealth methodically. Now, if you want to have more fun with it, you could also do something like 80% in index funds and 20% in individual stocks that you research and pick yourself. This gives you the core of a safe, diversified portfolio, but also lets you take some calculated risks on individual companies if you find ones you really like. But for your very first portfolio, I'd stick with the 3-fund approach and just keep it simple. Now let's talk about taxes, because this is really important, and a lot of people don't think about it until it's too late. When you sell an investment for a profit, the IRS wants a piece of that profit. It's called a capital gain, and you owe taxes on it. But here's the key thing. If you don't sell, you don't owe any taxes. So a lot of beginning investors make the mistake of buying and selling constantly, trying to time the market. And every time they sell, they trigger taxes. Whereas if they just bought and held, they'd avoid a lot of those taxes. Now, there are 2 types of capital gains, short-term and long-term. If you hold an investment for less than a year and then sell it, you owe short-term capital gains tax, which is taxed as ordinary income. So if your tax bracket is 35%, you'd owe 35% on your gains. That's painful. So if you hold for over a year, you get long-term capital gains, which is only 15 or 20% depending on your income. Much better. So there's already a tax incentive built into the system to encourage you to hold investments longer, which aligns with what we want to do anyway, which is long-term investing. The best way to avoid capital gains taxes entirely is to invest in a Roth IRA, as we talked about earlier, because the growth inside a Roth is never taxed. Another strategy a lot of smart investors use is called tax loss harvesting. This is where, at the end of the year, if you have some losers in your portfolio, you sell them at a loss, and you use those losses to offset any gains you made elsewhere, so your overall tax bill goes down. It's a pretty simple way to reduce your taxes without doing anything too complicated. So those are the basics of taxes. Nothing too crazy. You just want to be aware of it and factor it into your strategy. Now let me paint you a picture of what it could look like if you actually follow this advice. Let's say you're 25 years old and you start investing $2,000 a month. Every month, you're going to contribute to a diversified portfolio of index funds and individual stocks over the next 40 years until you're 65. Not that you have to work that long, but let's just say that's your goal. 40 years of investing $2,000 a month, getting an average 8% return, compounding every year. Do you know what you'd have at the end? You'd have somewhere in the neighborhood of $5 to $6 million. And that's with a fairly modest investment amount of $2,000 a month. If you could do $3,000 a month, that'd be closer to $7 to $8 million. The point is that wealth building is not some magical process. It's not about getting lucky on a stock. It's about consistency. It's about time. It's about compound interest doing its work year after year after year. And if you start early enough, literally anyone can build serious wealth. Not just rich people, not just business owners, anyone willing to invest consistently for decades. So I really hope you'll take this seriously and start investing, even if it's just small amounts. The earlier you start, the easier it gets, because time becomes your biggest asset. Now, there's one more thing I want to talk about, and that's the psychology of investing. Because honestly, the psychology is the hard part. The math is easy, but the psychology is difficult. When the market goes down, a lot of people panic. They sell everything at the worst time. They lock in losses when they should be holding or buying more. The market was down about 30% in 2020 when COVID hit, and a lot of people sold and missed out on one of the best bull markets that followed. The people who panicked lost the most. The people who held or kept buying did the best. So the most important thing you can do is prepare your mind for volatility. Understand going in that the market will have corrections. It will have down years, but over decades, it's always trended upward. So you need to have conviction in your strategy and not let emotion drive your decisions. Read books, learn as much as you can, and remember that every time the market crashes, it's actually a buying opportunity for young investors like you, because you're buying stocks on sale. If you have this mindset, you'll do incredibly well. Anyway, I really appreciate you watching this entire video. I know we covered a lot of ground, and I hope you found it valuable and educational. educational. If you got value out of this, please consider subscribing. And if you have any questions, leave them down in the comments, and I'll try to respond to as many as I can. I hope you start your investing journey today because the best time to plant a tree was 20 years ago, but the second best time is today. So start investing, start building your wealth, and I'll see you in the next video.